right, Alex, welcome to Out of Consensus. Good to have you.
Great to be here. Thanks, Armin.
So, Alex, you are the UK's policy exchange wizard in terms everything energy security, energy policies. Like for all people that don't know you yet, do you want to quickly introduce yourself?
Absolutely. My name is Alex Simakov. I'm the Senior Research Fellow on Energy Security and Climate Transition at Policy Exchange. We're the UK's leading think tank on public policy issues. I joined here in September, prior to which I worked as a policy advisor to a Minister of Energy in Canada, and then as a clean tech consultant for the past few years. Really excited to be in Europe at a critical stage in their climate transition.
Right. And before we hit the record button, we started talking about, so we had the Inflation Reduction Act. We are starting to see answers from Europe as well. Also, there's recently a lot of talk about deindustrialization, especially in Germany, due to structurally higher energy costs from now on. Take us back a little bit and give us some background, like where we're coming from and where do you see us going? And let's start with the macro perspective.
Macro perspective is post-Cold War, Washington Consensus comes on and the government embraces a very free trade, very free market agenda that on a macro global level has been exceptional for creating wealth, for uplifting billions from poverty,
right.
And has seen a light touch role from government that has seen industry develop organically, so to speak. For the 90s and into the 2000s, that seemed fairly well, where we did have a trade-off of small-scale deindustrialization, manufacturing declined out west, as the higher costs there pushed industry away towards Asia and other developing countries with much lower manufacturing and labor inputs. This was seen as an acceptable trade-off. The West was complemented by explosion in services, consulting, finance, folks who make podcasts. So the economy was going fairly well for a while. Global financial crisis in 07, 08 did tip the scales in a political sense, in that despite global growth increasing and national GDP increasing, there were very strong pockets of impoverishment throughout parts of America and Europe, the Rust Belts, that made politically difficulties. The government, nevertheless, states did not intervene in any meaningful sense. They did speak rhetorically about the need for more industrial capacity and creating middle-class jobs, manufacturing jobs. But the forces pushing those jobs away continued robustly, and we did see a collapse of manufacturing from about 30% of America's employment and GDP to the mid-teens. Similar numbers here in the UK. Germany was one of the few that bucked the trend and stayed strong in manufacturing because the government held on. The conversation we're having today, as you fast forward to the present, we've realized that if you don't decide on industrial policy through a government, somebody else will decide that for you. And in the Western case, that was largely high finance. The capital flowed to the most lucrative, the most remunerative possible processes, including the selling off of an asset in the West, reestablishing it in Asia, particularly in China. The challenge we faced was two things changed the dynamic. The first was COVID. We realized that once these free trade borders started to shake and we couldn't rely on our trade partners, we couldn't rely on just-in-time production, we couldn't manufacture a lot of things at home. We couldn't make very simple things like face masks. We couldn't make vaccines, much of all. We couldn't adjust to these shocks. We saw these massive lineups out of Los Angeles port of hundreds of ships waiting to dock, and we realized just how fragile industrial capacity was and just how we exported so much of our state capacity towards trading partners. The second event that really tipped the scales was the Russian invasion of Ukraine. That made us realize that those trading partners weren't particularly reliable, and the costs of doing business with them could be tremendous. Russia's gas was the cheapest source of gas for many years, but we realized last winter that those costs then came with tens of billions of pounds or euros or dollars had to be invested to make up for that difference. The environmental and security risks weren't properly factored into the market price, is what we're realizing. We're also realizing that we need to get a bit of a better control of our resources as well. We can't rely on third-party actors to deliver for us. What's really been acute for my conversation on the climate transition is on critical minerals and critical metals.
Right.
These are things like cobalt, lithium, nickel, very much in the news. What's happened with China is China's played a fantastic industrial strategy, just as the West abandoned the very notion. They started investing in EVs and other climate technologies over 20 years ago, plowing in tens of billions of dollars. And the critical mineral component is really at the center of their strategy. They took on the very messy, not very lucrative work of extracting rare earth materials and things like nickel and manganese, processing it at home, very environmentally destructive process, very poor labor conditions you have to work with, and then selling it at a loss out to the West. So they would sell it time and again for decades below the cost of processing and extraction. But they would lose tens of millions of there, and then they would gain billions by attracting first lower end and now advanced manufacturing with assured access to those critical supply chains. Saying, well, instead of us shipping our nickel or our lithium or cobalt over to Europe or America, very expensive process, how about you set up in Guangdong and Shenzhen, build your facilities here, and we'll give you a very good treatment, and you have a guaranteed domestic market to produce it by. That's been exceptional for them.
So, I mean, like in essence, then like, let me summarize it. We were all happy trading. And for some reason, someone else played, his card well, which is in this case is China, like taught us how to do industrial policy, quite successful. Now, since last year, we also know that, okay, so, our suppliers of energy might be not as stable as we expected. And geopolitics is actually a real thing. There seems to be some change in the air. Now we are doing policy ourselves and starting to become a little bit more like China, or look at it like us. So first of all, like, do I have this more or less right? And then, what does that mean? And what kind of policies are we seeing that you think like would be really significant, apart from like just the buzzword of Inflation Reduction Act, because these are like the big buzzwords, but what does it actually mean?
So I think you do have it right, and I think it would be a bit reductive to look at it as a game or a sports competition, but it is. We're competing against China with two very different visions of how the 21st century should evolve, and China has done a lot of immoral things with human rights both domestically and abroad, but it's nothing unethical for them to advantage their own industry and outcompete the West. They've done that well, and we should applaud them and learn a lesson. We have to learn a lesson that it is okay and good to favor your own domestic economy and your own domestic workers over an abstract global well-being. From what we have seen, what we've seen on domestically with the Biden presidency is actually very much a continuation of the Trump presidency in ideology, if not in form. It's very much when America first, we need to revitalize our industries and create things with American workers and American factories. The Inflation Reduction Act is part of a threefold of legislation, including the CHIPS Act, which focuses on semiconductors, and the Infrastructure and Investments and Job Act, collectively about $2 trillion worth of investment. So what IRA in particular does, we can describe it as $370 billion for clean tech investment. That's actually an understatement that the Democrats were very clever in pulling. Because their tax credits is actually going to be much higher than $370 billion. It's definitely going to be 200. It's going to be half a trillion at least. Goldman Sachs has estimated it might go as high as $1 trillion. So the sum of money in play is enormous. What it does is it provides tax credits, either an investment tax credit or a production tax credit, and that covers the cost in part of a very wide range of clean tech assets, from solar panels, inverters, turbines, electrolyzers. It's a very substantial list. That's part of it, if they're produced domestically. The other end of it is the same, covering a huge cost of building those factories to manufacture in the first place, again, domestically. These can be matched by state incentives, which are compounding. So you could invest, say, build $2 billion factory they're building in Michigan now for electrolyzers. Over half of those costs are covered by either IRA in combination with state subsidies. So to make an investment now, your costs of doing so are tremendous. It's also locked in for 10 years. So you have great certainty that until 2033, if you're signed up for it, you have that financial incentive. On the other end, it also affects demand side measures greatly. It says if you want to buy a variety of clean tech products, namely say an EV, we'll give you a huge tax credit to do so. So to buy an EV that qualifies, you can get up to $7,500 from the government. but it comes with conditions. And this is where IRA really changes the game from previous European particularly strategies. One half of the credit is made up of making sure that car is assembled in the US. So that means American jobs, American factories, etc. The more exciting part that it's doing as well is it's saying the value of the critical minerals has to be limited by how much of it comes from adversarial nations, namely China. So right now it's about 45% can come from China to qualify. And then after 25, every 10 years, every year, it drops by 10%. So by the end of decade, none of the critical mineral value can come from China or other adversarial nations like Iran, North Korea, Russia, etc. So this sends a really strong signal where, okay, if we want to take advantage of these very substantial credits, we need to have facilities here in the US that can process, extract, and refine critical minerals that can go into these batteries so we can take advantage of the credits. Right. And the scale of money we're talking about tips the calculus from saying, well, China will give us cheaper power and labor, and weak labor laws. The US will give us quite a bit of money and we can continue to invest in a domestic economy in a market that we trust and want to support.
And like from the European side, there was obviously a lot of reaction. I think a lot of beef, but in the transatlantic relationship because of the Inflation Reduction Act. So, what are kind of concrete policies can we see there that we just want to quickly nail down?
Mm-hmm. It's been really exciting watching the European response from August to now because it's completely turned around. I mean, 360 is an understatement. It's kind of wrapped around a few times, I think.
See. Okay.
It's also a good opportunity for us to help draw the contrast between what Europe as a climate leader for the past 2 decades has done versus the US. Europe's strategy, while they've very much celebrated and invested in clean tech, has been foremost an emissions reduction strategy. Mm-hmm. Their goal says, we want to cut emissions by 10% over a certain period. What do we need to replace to do so? And that has great results. The EU has cut some of its emissions. Some of it was exported abroad through carbon leakage, but a lot of it was earnestly cut through, say, power generation, taking coal, turning it into wind. The problem is, from an industrial perspective, if you're here in the UK, which they like to celebrate their climate transition into wind, if you shut down a domestic coal plant and you replace it with a wind turbine, great, your emissions are cut. But if you bought that wind turbine abroad, manufactured by foreign workers in a foreign factory, that hasn't helped your industry. You haven't supported those jobs domestically and so forth. That's where the IRA very much says you need to do this domestically with domestic workers. So at first, the European Union was upset because the provisions in IRA made sure it was domestic workers, domestic factories, excludes eligibility for EU facilities, of course, and EU factories and jobs, which the EU hasn't done to its trading partners, because this is quite openly not in line with WTO rules. The WTO called it, compared it to doping in sports, the Davos. They talked about how we won't engage in a race to the bottom. But what's happened over the past several months is quite quickly, the US has brought in billions and tens of billions and now hundreds of billions of capital investment into its advanced manufacturing sector. So it's changed the EU's minds a lot by saying, well, we're not going to shame America into dropping this. Maybe we should actually mimic them. So first there was a Euro Fit for 55 plan that then evolved into the Green Deal industrial plan. And now you have President of France talking about the need to re-industrialize the continent and build gigafactories and so forth. So in practice, what they've done is they've waived EU state aid rules. So there was until this waiver, you couldn't, as a country, subsidize a domestic producer that's just, say, Austrian. If you offered a subsidy, you would have to be eligible for all of the EU members. The problem is it's hard to convince your voters that you should raise taxes, generate money, and then that might go to your historical rival across the way. They've said, for us to really drive the level of investment that we've seen in the US, we're going to need to help match that with some of these subsidies. So they've waived the rules, and now larger or wealthier countries, particularly France, has been a big leader in this, is raising capital and subsidizing through production or investment tax credits, investments into the domestic economy.
It's quite interesting, and that's why I would love to hear your, outlook, any outlandish predictions that you might have with all of the evidence, because what you're describing is very much, okay, so all energy intensive industries are now pretty much watching policies that are coming from different sides And even though it looks like stability and certainty, yes, we guarantee this for 10 years, as you mentioned. But like, you always look at the other side and say, wow, there's like maybe like some better opportunities because now we have new policies. We have someone else in power, and they are, even more bullish on more green industrial policy.
I think what's going to happen nearer term is the U.S. has a lot of money. It can raise a lot of money, it can spend a lot of money. Europe and frankly the rest of the world can. So I do think the subsidy train has to slow down. I don't think we can indefinitely throw a lot of this money. We're seeing these challenges, for example, in Canada. An offer was made to Volkswagen, to LG Stellantis, a combination to make batteries in southwestern Ontario, where I'm from, last year, and there was a deal was agreed. Once a few months later, another deal was signed with Volkswagen. This was post IRA. With a lot more generous subsidies on the table. So LG Chem and Stellantis come back to the government and say, well, actually, for us to follow through on our investment, we're going to need more money from you. So that's politically very difficult, I think, for the government to say, well, we've signed a deal, here's more capital, and definitely it can bleed out. And it's also not economically the most optimal way to spur an industrial strategy. What you really want to do is you want to build infrastructure, you want to build ports, you want to make sure they have power. And that comes to the real big issue of what Europe in particular is going to come up ahead is power shortages and power prices. It's one thing to run an office. It's one thing to be a consultant. We're not very energy intensive people, but to manufacture steel or chemicals, huge quantities of energy that are not really available in the EU ever since Russian gas flows were curtailed. That those aren't coming back soon. LNG has picked up, but that is a tighter market, especially as Chinese economy fully recovers from COVID and this lockdown. Energy demand is going to get tight again. Next winter is far from solved. So we're going to have limits there. What the West needs to do collectively is it needs to start expanding its industrial supply chains to non-aligned countries that do have tremendous energy resources that haven't been developed and haven't been put to use, and have those countries take on a larger share of the energy-intensive downstream and midstream parts of the industrial process. So that means instead of bringing over the raw materials to Germany or France and processing them there, we're going to have to leave a much larger portion of that downstream activity in parts of Africa, Latin America, and non-aligned parts of Asia, where they can take on a larger share of the load. Same thing with labor. We don't have that many mechanical, talented, skilled tradesmen and women available throughout the West anymore. They've all took on humanities degrees and make podcasts. So we're well stocked on those, but we do need a labor supply that isn't available for reindustrialization. The priority here has to be a decoupling from China and saying, instead of looking for China for our labor industrial supply, we have to look at alternative options throughout the rest of the developing world. It also is critical because that helps them bring into our economic orbit again, and giving them opportunities instead of just being resource extraction facilities. I think that's going to be a great bedrock for us to have closer economic and political ties as well.
And do you see this at the at which part of the supply chain? Because obviously, so recently I had someone on the podcast that was talking about the opportunities for LNG exports from Israel, and there are a lot of creatives ideas out there. So when you look for these solutions, is this just from what's the what's the preferred way? Do you buy the end product? Do you kind of really go down and because there's a lot of upfront investment obviously to be made, right?
Where we have to do is we have to be a bit more critical in thinking about industrial strategy, where there are certain countries that can seize the upper end of the value chain. Germany has obviously a lot of experience with cars, struggling with that transition with EVs per se, was a slower mover on that compared to, say, China. Here in the UK, huge opportunity in the hydrogen space. So electrolyzers and fuel cells, something that we can dominate in. Or be very competitive in as well. Obviously, Denmark is a pioneer of wind turbines and has continued to be in that space. So I think there's nothing wrong, and I think it's essential that some of the Western allies start getting together and discussing, allocating up the pie of which countries do we really want to see being leaders in some different green industrial sectors, supporting those supply chains. Where we do have other countries, for example, there's a conversation about shipping out hydrogen as ammonia from Namibia up into Western Europe. That to me doesn't make much sense because you're going to lose a tremendous amount of that energy in the journey. Instead, produce that ammonia and then consume it in Namibia. Set up the refining facility, set up the steel production facility or the lower end value chain there, and then export a more finished product or a more higher up the value chain product to Germany, where it can be assembled and put into final use. So that's something that politically we have distorted in a way, because a lot of these kind of steel production jobs, very photogenic politically. You want to support these communities. A lot of these factories are one factory towns. So huge political polls that we've made to support those. But the thinking has to be, how can we convert that steel facility into a more advanced, electrolyzer fuel cell facility, and work with a developing nation trade partner for them to take on a larger share of our supply chain as well.
And you are around in a lot of circles that are discussing exactly that. What discussions do you hear right now? Okay, so there are some places that you just mentioned. Is there anything else that you think wow, this is really worth paying attention to?
I think what's coming down the pipeline hard and fast is going to be addressing carbon leakage in terms of a specific policy that can help shift the dial for us. It's that carbon leakage is the notion that you impose a tariff, a trade tariff, on the carbon intensity of a specific good. So a lot of countries, throughout the EU and the UK, we have the emissions trading scheme, which puts a price, or rather, it's a buying allowance for each ton of carbon you emit. The EU is already moving forward on this. Well, just last month, they passed the final round of legislation, and it's coming into effect gradually. It's going to be fairly limited at first because it is a complicated process. It's easier to do on something like, say, steel, where it's a fairly contained commodity. You can, depending on where it was manufactured, understand, well, what was the energy, carbon intensity of the electricity and the facility and so forth. But something like a car that could have 1,000 of components, very difficult to actually calculate with great confidence what the carbon intensity is going to be. So that's slowly expanding. An alternative approach or to carbon leakage is what the US is looking to do with the green steel and aluminum pact with the EU. And that just sets a maximum floor of how much embedded carbon can be in products. This is great because what we've done for a long time here in the UK is we've invested in decarbonizing our power system. That doesn't always reflect itself in the market value. China, which can build a coal-fired facility, cuts on its monetary costs at great environmental costs. So we're factoring those decisions into a market price, and that's one of the directions. The other point as well has to be on getting our head straight on critical minerals. Much like Russia's been able to do with gas, China has a huge opportunity to apply economic leverage over us from the critical mineral supply chains. We saw that in 2011 when they cut off supplies to Japan after a dispute over an island chain. A couple of things are possible there. One, we do need to think 20 years ahead because a modern mine takes a decade plus to fully bring online from idea to output. A strategic critical mineral reserve, I think, would be a very important way for us to build up supply stocks, which discourages countries from being able to abuse that leverage. It also provides a price modulator. It stabilizes prices. A big concern with some of these less liquid metals is that you can flood the market and the market price collapse, and then the investment you've been working on for 5 years is wasted. China's done that a few times very well. They will sometimes see prices slowly creep up. Western investors come into the market to try to develop that resource. China floods the market, and then when that asset goes into receivership, a Chinese-owned company buys it. So it's been a brilliant strategy, and we have to hand it to them. But the way you can mitigate that is through contracts for differences, for examples, where the state steps in as a buyer of last resort. They say, if you're willing to invest in a minor metal or an illiquid metal, because this wouldn't work for things like copper or even nickel and other larger lithium assets, but things like niobium, for example, might be viable. You sign a contract where hopefully you can get an off-taker for that company. And if not, the government will buy it from you or through a state entity or a bank. That sets a minimum floor price, but also if the price does exceed, the state can develop a return on it. By building up a strategic reserve, we'd be able to do things like release some more resources when prices do get high to the point of crimping down on available production. And then we can buy when prices collapse to make sure there is a bit of a floor, so we can stabilize them that way. I think that's going to be really important, and it has to be a long-term plan over a 10, 20-year horizon, because we do need to be thinking about a 2050 target, and it's not something we can fix soon.
So Alex, before we wrap this up, and now, because one takeaway that I have from this conversation is that, okay, so we are discussing a lot of alternatives, all with the aim to pretty much become more sovereign in general, right?
Mm-hmm.
And when you look at the policy discussions that you are following, do you see any, can be in critical minerals, can be in another area where there's not a lot of attention on, but it's that you think is really critical, and that where there is actually, apart from all of the talking, there's actually some sort of probability that we are, getting something implemented?
I think what's being really overlooked, it's very acute in the UK, but I think it applies in many other parts as well, is the role of natural gas.
Right.
So right now we're talking a really big conversation about transitioning away from fossil fuels and electrification, and we are, and the share of renewables is certainly growing. But we do know that until the end of the decade, at least, we are going to have an increase in natural gas demand for a number of reasons. Here in the UK, we have a couple of nuclear plants that are retiring. For example, we do need to make sure that we have that supply locked in. We do need to make sure we have the infrastructure to import it and then pass it on to the customers. At the same time, instead, we're having a conversation about shutting down existing supplies and shutting down infrastructure and so forth. So we keep making this problem of targeting our reliable supply without focusing on the demand. But if you push supply down faster than you can demand, it puts you into these really complicated situations like we saw with that Russia put us into. This time, we're imposing it upon ourselves. So it's a huge, I think, oversight right now for us to be a bit too zealous about how fast we can decarbonize. And I think, particularly acute in the power generation sector, the idea of 100% clean grid sounds great, but you really get to diminishing returns past 80, 90%. We should be aiming for a 80, 90% clean grid, and then you have a small reserve of peaking capacity for natural gas. If you're talking about overall climate emission reductions, carbon emission reductions, that's the way to do it. You decarbonize as much as you can on the power grid, and then you focus on transportation, you focus on heat, because you need cheap electricity to do that. If you push out all of the gas and you force us to rely exclusively on batteries or other storage assets that are developing quickly but aren't being deployed quite as quickly as we need them to, you're going to put ourselves in a very difficult situation where electricity costs skyrocket and it becomes impossible to decarbonize some of those hard to decarbonize sectors that would rely on electric arc furnaces or EVs and so forth. So I think that's a big mistake that we might be heading onto, and we need to be really critical about how quickly we can get gas out of the system, because if we move too quickly, our overall emissions reduction strategy would be undermined.
And I can imagine that's a little bit unpopular. So do you see the snapping back that people are saying, okay, well, it's all good, but like we need the natural gas discussion now because it's just a necessity?
Looking at the political parties here in the UK, I think there is a commitment to the timelines. I think when you have a public conversation with some of these decision makers in a panel or a session, very much so, we're going to decarbonize, is going to happen. But speaking with their policymakers in private, there is a very real awareness that it's physically not possible to do it by 2030. So it's a challenge I think everyone in the sector is aware of. We don't quite know how to square that circle. But hopefully the experience of the past 2 years has made people a bit more critical about how quickly and ambitiously we can move and how important it is to have that buffer and that wiggle room. So I think cooler heads will prevail, and we'll be in a stronger position for it.
Alex, apart from Cassandra, where people can talk to you, where else can people follow your work?
Check us out, our page on Policy Exchange. We put up our reports fairly frequently across the entire range of the policy area. One of the opportunities as well, paper we're working on now, touches upon a lot of these conversations, including the Inflation Reduction Act.
Okay, great. Alex, thank you so much for being here. Cheers.
Thanks so much, Armin.